Welcome, everyone. Today, we are going to dive into something really powerful that can change how you see trading. We will be exploring how to use the Candlestick Volume Profile in RTrader Pro. This is such an incredible tool because it allows you to get a better idea of what is really happening with price movements and market activity. By the end of this session, you will know how to set it up, read it, and most importantly, how to use it to improve your trading decisions. Are you ready to take your trading skills to the next level? Picture this: what if you could not only see where the price is moving, but also understand the power behind those moves? That is where the Candlestick Volume Profile comes in. Imagine combining a regular candlestick chart with a detailed map that shows where most of the action took place. The Candlestick Volume Profile does just that. It tells you not only where the price has been moving, but also how much trading volume happened at each price level. This combination of information is extremely useful. If you know not just where prices moved, but also the strength of those moves, you can make much better decisions. Now, let us expand on the types of candlestick patterns you might encounter. One of the most common patterns is the hammer. A hammer is a bullish reversal pattern that occurs after a downtrend. It has a small body and a long lower wick, which shows that buyers stepped in after sellers tried to push the price lower. This pattern, when confirmed by high volume, can signal the end of a downtrend and the beginning of an uptrend. Another important pattern is the shooting star. This is a bearish reversal pattern, often seen after an uptrend. The shooting star has a small body and a long upper wick, showing that buyers tried to push the price higher, but sellers took control and drove it back down. If this pattern appears at a high volume resistance level, it can be a strong signal of a reversal. We also have the bullish engulfing pattern. This pattern appears when a small red candlestick is followed by a larger green candlestick, which completely engulfs the previous candle's body. This indicates strong buying pressure and often signals the start of an uptrend, especially when accompanied by high trading volume. Similarly, the bearish engulfing pattern occurs when a green candle is followed by a larger red candle, which engulfs the previous one. This indicates that sellers have taken control and can signal the start of a downtrend. The effectiveness of this pattern increases when it happens near a high volume resistance area. Another key pattern is the doji. A doji forms when the opening and closing prices are almost the same, creating a very small body. This pattern represents indecision in the market. When you see a doji at a high volume area, pay close attention as it could signal a reversal, especially if there is a strong trend preceding it. A morning star is another bullish reversal pattern that is worth noting. It is a three-candlestick pattern where the first is a long red candle, followed by a smaller bodied candle, and then a long green candle. This pattern signifies that the downtrend is losing momentum, and buyers are starting to gain control. When this pattern forms at a high volume support level, it can be a strong indicator of a trend reversal. On the other hand, the evening star is a bearish reversal pattern. It also consists of three candles, a long green candle, followed by a smaller bodied candle, and then a long red candle. This pattern indicates that an uptrend may be coming to an end, especially when confirmed with high volume at a resistance level. Recognizing these patterns and combining them with the information from the volume profile allows you to better understand the market sentiment. You will start to see not just the price action, but the intention behind those moves, whether buyers or sellers are gaining strength, and where potential reversals may happen. This deeper understanding can significantly improve your ability to make profitable trading decisions. Now, let us get started with setting up the Candlestick Volume Profile in RTrader Pro. To begin, we need to navigate to the indicator menu. Go ahead and look for the section called Volume Profile. When you find it, there will be an option to combine it with candlesticks. Make sure you select that. Once you have applied it, you need to choose the right time frame. The time frame you choose depends on your trading style. If you are a day trader, you will want to use shorter time frames like 5-minute or 15-minute charts. If you are more of a swing trader and like to watch trends over longer periods, you might prefer hourly or daily charts. That helps capture the bigger picture. Once you have picked your time frame, you can customize the display. You want to adjust the colors and bar thickness to make sure the volume profile is easy to read alongside your candlesticks. The key to using the Candlestick Volume Profile effectively is understanding its different components. Let us break it down. First, we have the candlesticks. Each candlestick represents price action over a set period. It tells us 4 important prices: the opening price, the high, the low, and the closing price. If the candlestick is green, it means that the price moved up during that time period. If it is red, the price went down. The volume profile, which we add alongside the candlesticks, tells us how much volume was traded at each price level. This is crucial because areas with high volume often act as support or resistance. Meanwhile, areas with low volume show us where the price moved fast without much resistance. You will also see the point of control, or POC. This is the price level where the most volume was traded, and it can be a key area in the market. Now, let us expand on the various types of candlestick patterns that traders commonly use to make decisions. Understanding these patterns thoroughly can significantly enhance your trading strategy. One important pattern is the hammer, a bullish reversal pattern that usually occurs after a downtrend. The hammer has a small body and a long lower wick, which indicates that sellers tried to push the price lower, but buyers stepped in and pushed it back up. The hammer is especially powerful when confirmed with high trading volume, as it can signify the end of a downtrend and the beginning of a potential uptrend. The inverted hammer is another bullish reversal pattern that also occurs after a downtrend. It has a small body, a long upper wick, and little to no lower wick. This pattern suggests that buyers are trying to gain control after a downtrend, and if followed by a strong green candlestick, it can signal a potential upward reversal. The shooting star is a bearish reversal pattern that appears after an uptrend. It has a small body and a long upper wick, which indicates that buyers tried to push the price higher, but sellers regained control and drove the price back down. This pattern, when appearing at a high volume resistance level, is a strong indicator of a potential reversal. The bullish engulfing pattern is a powerful reversal signal that forms when a smaller red candlestick is completely engulfed by a larger green candlestick. This indicates strong buying pressure, especially if it occurs at a high volume support area. It suggests that buyers have taken control and can often mark the beginning of an uptrend. On the other hand, the bearish engulfing pattern is a bearish reversal signal that forms when a smaller green candlestick is followed by a larger red candlestick that engulfs it. This pattern is significant when it appears near a high volume resistance level, as it indicates that sellers have taken control, potentially marking the start of a downtrend. The doji is another key pattern that represents indecision in the market. It forms when the opening and closing prices are almost the same, creating a very small body. The length of the wicks can vary, but the key takeaway is that neither buyers nor sellers were able to gain the upper hand. When a doji appears at a high volume area, it could signal a possible reversal, particularly if it follows a strong trend. The morning star is a bullish reversal pattern consisting of 3 candles. The first is a long red candle, indicating strong selling pressure. The second is a smaller bodied candle, which can be red or green, showing that the selling momentum is slowing down. The third is a long green candle, indicating that buyers are stepping back in. This pattern, especially when it occurs at a high volume support level, signals that a reversal to the upside may be underway. Conversely, the evening star is a bearish reversal pattern made up of 3 candles. The first is a long green candle, indicating strong buying pressure. The second is a smaller bodied candle, showing indecision, and the third is a long red candle, indicating that sellers have regained control. When this pattern forms at a high volume resistance area, it often signals that an uptrend is coming to an end. The spinning top is another pattern that reflects indecision in the market. It has a small body and wicks of roughly equal length. This pattern shows that there was a struggle between buyers and sellers, but neither side gained significant ground. When a spinning top appears in a high volume area, it can signal a potential change in trend direction, especially if it comes after a strong upward or downward movement. The harami pattern is a 2-candle pattern that can either be bullish or bearish. In the bullish harami, a large red candlestick is followed by a smaller green candlestick that is entirely within the range of the previous red candle. This suggests that selling momentum is slowing down and buyers might be gaining control. In the bearish harami, a large green candlestick is followed by a smaller red candlestick, suggesting that buying momentum is weakening. The significance of this pattern increases when it forms at a high volume support or resistance level. The 3 white soldiers pattern is a bullish continuation pattern consisting of 3 consecutive green candlesticks, each with a higher close than the previous one. This pattern indicates sustained buying pressure and often appears after a period of consolidation or a downtrend. The strength of this pattern is confirmed if accompanied by high trading volume, indicating that buyers are committed to driving the price higher. The 3 black crows pattern is the bearish counterpart of the 3 white soldiers. It consists of 3 consecutive red candlesticks, each closing lower than the previous one. This pattern indicates sustained selling pressure and can signal the beginning of a downtrend, particularly if it appears at a high volume resistance level. Recognizing these patterns and using them in conjunction with the volume profile can give you a better understanding of market sentiment. By identifying these candlestick patterns and confirming them with high or low volume levels, you can make more informed trading decisions. Whether you are looking for trend reversals, trend continuations, or potential breakout opportunities, understanding these patterns in detail will help you identify key opportunities and avoid common traps. Now that we understand the basics, let us talk about how to use the Candlestick Volume Profile to spot trends. Imagine you are looking at an uptrend. You will usually see green candlesticks, and you will notice that the volume is increasing as the price goes higher. This tells us that buyers are stepping in and are in control. On the other hand, if the volume starts to decrease while the price keeps going up, that is a sign that maybe the uptrend is getting weaker. In a downtrend, it is the opposite. You will see red candlesticks with increasing volume at lower price levels, and this confirms that sellers are in control. However, if the volume drops while the price keeps falling, it could mean a potential reversal is coming up. Whenever you see volume spikes at key levels, take notice. This often signals a change in the direction of the trend, and you will want to be prepared for that. One of the most useful things about the Candlestick Volume Profile is its ability to help us identify support and resistance levels. These levels are very important in trading. High volume areas, which we sometimes call high volume nodes, are where a lot of trading happened. This means that these areas often act as strong support or resistance. When the price reaches these levels, it tends to stall or even reverse. This is because the high volume at these nodes represents significant interest from both buyers and sellers, creating a natural barrier. On the other hand, areas where the volume is very low, also known as low volume nodes, indicate that the price moved quickly with little resistance. These low volume zones can be key opportunities for breakouts or breakdowns when the price revisits them. The lack of significant volume means that there is less interest from traders at those levels, allowing the price to move freely and rapidly. These zones often act as price gaps that the market can fill quickly, making them ideal for traders looking for rapid movements. Another critical component of the volume profile is the point of control or POC. The POC is the price level where the highest volume of trades occurred, and it often represents the area where the most consensus exists between buyers and sellers. This level can act as a magnet for price, meaning that prices often gravitate back toward the POC after diverging. For traders, the POC is incredibly useful for planning entries and exits. For example, if the price moves away from the POC and volume starts to fade, it is likely that the price will return to the POC, offering a potential entry point. Conversely, if the price is approaching the POC with strong volume, it could indicate a significant breakout or breakdown. High volume areas often indicate strong support or resistance because a lot of market participants have shown interest at those levels. These levels can be used to set stop losses, take profits, or even enter new trades, depending on the current market context. When combined with candlestick patterns, these areas can provide even stronger signals. For instance, if a bullish engulfing pattern forms right at a high volume support level, this could be a very strong indication that the price is about to move upwards. Similarly, bearish patterns at high volume resistance can suggest a downward movement is likely. In contrast, low volume areas can indicate price inefficiencies or zones where the market moved too fast without much opposition. When the price revisits these areas, it can often break through with little resistance, making them ideal targets for breakout traders. For example, if a shooting star pattern appears just below a low volume node, it may indicate a strong potential for a downward breakout. Recognizing the significance of both high and low volume areas and understanding how to use the POC effectively will help you become a more confident and successful trader. Prices often move back to the POC, so keeping an eye on it can make a huge difference in identifying key trade opportunities and managing your risk effectively. Let us make this even more powerful by combining candlestick patterns with volume profile data. If you see a bullish pattern, like a hammer or an engulfing pattern, right at a high volume support level, that tells you that buyers are really stepping in. They are not just appearing randomly, they are coming in where a lot of action happened before. The same thing goes for bearish patterns, like a shooting star or a bearish engulfing pattern, when they happen at a high volume resistance level. That is a clear signal that sellers are taking control. Always remember that volume confirms these patterns. If you see a bullish pattern with rising volume, it means there is a strong chance that the price will move up. A bearish pattern with high volume signals that the price may be heading down. Paying attention to this combination can really help you make smarter trading choices. Let us go into some practical trading strategies now. First, let us talk about breakout trading. When you see the price breaking above a high volume resistance area and the volume is strong, that usually means that the breakout will hold. You can then use the candlestick confirmation to enter the trade. For reversals, pay close attention to volume spikes at major support or resistance levels. If you see a candlestick reversal pattern, this can be an opportunity to trade in the opposite direction. Lastly, for trend continuation, you want to look for pullbacks to high volume areas during an existing trend. When the candlesticks and volume both point in the same direction, that is a strong sign to jump in and continue riding the trend. Avoiding mistakes is just as important as learning strategies. There are a few common mistakes people make when using the Candlestick Volume Profile. The first mistake is ignoring volume at key levels. For example, if the price is approaching a high volume area but the current volume is low, the move may not hold. It is important to be cautious in these situations. Another mistake is making decisions based on just one candlestick. Always look for confirmation from both the volume profile and multiple candlestick patterns before making a move. Additionally, it is crucial to understand the nuances of different candlestick patterns and not assume every pattern will have the same outcome. For instance, a hammer pattern may signal a reversal, but without volume confirmation, it might not be reliable. Another common mistake is failing to recognize when a candlestick pattern is forming within a consolidation zone. Patterns like bullish engulfing or bearish engulfing are more effective when they appear at the end of a trend rather than within sideways market movement. Misinterpreting these patterns can lead to false signals. Traders must also pay attention to the strength of the preceding trend before identifying any reversal patterns. For instance, a morning star is more significant after a strong downtrend compared to a minor pullback. Also, make sure that your time frames match. If you are using a 15-minute chart for candlesticks, make sure that your volume profile is also set up for that time frame. Mismatched time frames can lead to bad decisions, so double-check before you act. It is also important to recognize that not all patterns are equally strong across different time frames. A pattern that looks promising on a shorter time frame might be less significant on a higher time frame. Understanding the context of the time frame you are working in is key to making sound trading decisions. There are also ways to fine-tune your volume profile settings to match the current market conditions. If the market is very volatile, you might want to increase the sensitivity of your volume profile. This will help you capture more detail. If the market is slower and not moving as much, it is better to lower the sensitivity so that you can filter out the noise. You can also change the colors of your volume bars to match your candlesticks. This makes it easier to see which side has more support from traders, which helps you make decisions quickly. In summary, the Candlestick Volume Profile is a fantastic tool that gives you a deeper understanding of price and volume. It helps you see where the support and resistance levels are, find trends, and confirm candlestick patterns with real trading volume. Start by adding the Candlestick Volume Profile to your charts. Then practice looking for those high volume areas and key candlestick patterns that we talked about today. This will guide you in making better entries and exits when you are trading. The Candlestick Volume Profile can give you the edge you need in your trading journey. Keep practicing, stay patient, and soon you will be reading volume and price like a pro. And as you practice, keep those questions coming and feel free to share your experiences with these tools. Let us keep learning and growing together.